All right, let's call the meeting to order.
Are you able to hear Laura? Can you hear Landon?
I can.
Okay, good.
Okay, let's see here, roll call. Laura, good morning. Landon,
Here.
Danny Covey, Mark Gardner,
Here.
Joel Hawkins,
Here.
David Hawley,
Here.
Mark Munson,
Here.
Solomon Ashby, Derek Challenger,
Here.
Shannon Glover, Elizabeth Gooden,
Present.
Patty Phillips.
Here.
We have a quorum. Look you.
Okay, next item is approval of the meeting minutes from the November 2019 meeting. Does anyone have any comments, revisions?
I move, if nobody has any objections, that we approve as written. Second.
All in favor?
Aye.
Aye. Any nays? Minutes are approved. Next is applications for retirement.
There are no
Miss-
applications for retirement for either the Fire and Police Retirement System or PRS. There were 2 reported deaths, and there are a total of 28 active participants, 14 in fire and 14 in police.
Thank you.
Welcome.
Next, Ms. Phillips, will you take us through the fund flows?
Okay. We've got the OPEB, the front load is on the end of the packet. My glasses on for this. This is based on a trust statement we received from John Hancock. And I'm not going to go over everything other than to point out in December, there was that $6.5 million that City Council approved as a part of the savings in fiscal 20 regarding the pension obligation bond refunding. And that has been deposited here, as you can see that. And it also has the showing the payments going out to John Hancock so they can make benefit payments to the retirees, and coming down in the dark blue highlight, $222,288,106.33, and that includes $4,155,000. Can you find that sheet? It's on the back of your packet.
I have through November. Are you looking at through December?
I am.
Yes, there should be a November and a December.
Go one page back.
Oh. Flipped one too far. Okay.
Okay, caught up. You see that? You see it
The
now?
numbers too. Good and fine.
So the 6 million is, if I'm remembering correctly, it's about half of the total savings.
Actually, it's much more than that. The total was 8.9 million, but it would be realized, that savings would be realized over a 3-year period, most in year 1, which is fiscal 20. And so we appropriated the $6.5 million. We'll do going from memory now, about 1.5 million in fiscal 21 and about 800,000 or 900,000 in fiscal 22 to bring it back to that original number.
Okay. Anyone else have any questions on that? No. All right, next update on the OPEB trust by also Ms. Phillips.
This is also in your packet. And it's a Co-America bag. Like this. And Co-America down here in the corner, lower right. And the balance at December 31st $4,489,122.58. So your representative on this body is, who attends these meetings on your behalf?
I attended one last year.
Okay. So, okay, they meet, I think, 3 or 4 times a year. Is that okay?
I don't know. I just know that we went to the one annual meeting.
Okay.
I think it's one that the local participants meet at.
Okay. Okay. In other words, you are not elected to the Board of Trustees.
Correct.
Okay. Very good. All right.
So yeah, I think one meeting, a representative from the local boards are invited.
Right. They talk about, at that point, the asset allocations and so forth, right?
They do?
And, okay, I had really thought you were on the board, so next meeting I will make sure we get a little more information on the asset allocations and so forth, just so this body will know and compare it to what we're doing with the retirement funds.
So-
There are not a lot of differences.
I think that meeting was back in September.
Yes.
And I did give a brief report on it I think it was at the November meeting. But they have basically two strategies of portfolio 1 and 2. One's like roughly, I think one's a 60-40 allocation and one's 70-30 or 80-20. I think we're in the more conservative one, but I'd have to go back and look. It would be good, maybe next meeting when they have the full year results to report those here, which I don't have.
Right, we'll do that and talk about the differences. I recall the differences of portfolio 2 is a lot more fixed income, less equity.
Do you recall, or does somebody recall how much we initially put into that?
Right now, the city has been putting in roughly $1 million a year the last couple of years, and I think every year it's a new budget decision on what we're able to do.
So it hasn't been that long. Maybe it was 4 million and now we have 4.5.
Right.
I seem to recall it was 4 million that we started out with, yes.
Yeah. We budgeted $1 million.
That was 3.
Yeah, we
It was 3.
started off with 3.
3, okay.
Really?
3 million, yes.
And we put in 3 and then added the 1.
It's been doing pretty well. Okay. So maybe next meeting we'll do a short report on the full year investment results of that.
I am having difficulty hearing Landon.
Sorry, I just said, so next meeting we'll have a short review of the investment results on that OPEB trust. You hear that?
Yes.
Okay. Moving on. New business. Introduction of a new board member. You like to handle that?
Sure, be happy to. We have Joel Hopkins from the fire department.
Right.
Yes, he's replacing David Harrington, and he's joining us just because we're a lovely group. Thank you for being here. And how long have you been in the fire department?
Going on 30 years.
Okay. All right. So this directly probably affects you?
Absolutely.
Affects you? Okay.
Like, you're one of the few remaining active participants?
Right.
All right.
Yes. So thank you for being here. Appreciate it.
Thank you.
Thanks. Next item, we have, we had a investment committee meeting yesterday, which We meet a minimum of 2 times a year. We plan on meeting again towards the end of the year.
Pardon me, Mr. Landon, I got that wrong. There is actually nothing in the bylaws that say 2 to 3 times per year. I just wanted to throw that out because I know we had a little bit of debate yesterday about that.
Okay. Well, with that being said, maybe we'll tentatively plan for another meeting at the end of the year.
Yeah, we'll just play it by ear, depending on how the year goes. Is that good with y'all?
Yep. Sure.
And we'll marry that with one of the other full board meetings so that it's easy for you guys.
Thank you.
A quick sort of summary of that meeting, we spent probably an hour and a half primarily reviewing the allocation and the risk metrics, some of the scenario analysis around around drawdown possibilities and value at risk. The sort of takeaway is that we're comfortable with the current allocation that we have and don't recommend any changes. That's really all I have to say about it, unless Brian would like to say anything else. But
No, I think that pretty well covered it, Landon.
okay. Next, Milliman actuarial evaluation, the retiree health care plan.
Do you recall that? That was an item that was involving HR as well, about former, there was an email about former employees who did not take advantage of the pension plan.
I
Okay.
haven't seen that email.
Okay, then I'm mistaken with that. So may we cross that from the agenda?
Yeah.
John Hancock does the actuarial study for us. We also have one done by Milliman for purposes of the financial statement and, doing some scenarios in the notes to the financial statement. As you know, the annual financial statement is not complete for fiscal 19. So I fully expect that to be done real soon, and I'm going to bring you all the pages of the notes that apply to this to kind of give you a flavor for all that.
Is that related to the OPEB trust?
Oh,
The retiree
yes.
health care, the assets in the OPEB trust are supporting this obligation?
What you do is you record on the entity-wide financial statements the actuarial liability on the cities. The city's responsible for these future payments, so that's a actuarial calculation. You place it on there, and those are not the city's assets, but you reduce the obligation for the amount of the assets. So
If I remember, we knew we get the actuarial estimates of liability from our current consultants for the retirement system. Now that we're responsible for the OPEB, we asked where that was coming from for the OPEB, and I think that's why it ended up on the agenda, is we wanted to see what liability we were responsible for meeting. So I think that's why it made the agenda, is we
Yes.
wanted to see that when it was
yes,
available.
thank you. And I will get you that.
Okay.
We have that.
Then the next item is the review by Greystone. Before we do that, I thought this was on the agenda, but if I can add to the agenda, can we ask if there's any volunteers for a new member to the investment committee? We currently have only 2 since we lost David Harrington as he stepped away from the board or fulfilled his term. So if anyone would like to raise their hand.
I'd be happy to do that.
Okay. And I assume we need to vote on that? Is that right?
Sure.
We have a motion to approve the appointment of Mr. Munson to the investment committee.
Second.
All in favor?
Aye.
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 Okay. Approved. Welcome aboard.
Okay.
All right. Greystone, take it over.
Thank you, Landon, and good morning, everyone. We're delighted to be here with you today, and I don't know if it's too late to say it, but I'll say it anyways. Happy New Year, even though we're halfway through February, seems like. We're going to speak from this. It's a bound report called City of Portsmouth 4Q 2019 Review. So in here is a review of capital markets and our portfolio for the fourth quarter of 2019, but we're going to focus on the full year. Just in a very high level, fourth quarter was good too, but 2019 was really good, so we're gonna talk about those results. If you can flip ahead to slide 5, here's a quick snapshot of the returns of the major capital markets. So 2019 ended with a bang, and it was a good bang. Fourth quarter returns for equities globally were about 9% in one quarter. For the full year, depending on what index we're talking about, returns ranged anywhere from 18, 19% to north of 30% for the full year in 2019 in equity markets. And in particular, the S&P 500 was one of the strongest returning markets around the globe. The return on the S&P was 31.5%. And so as I was preparing for this meeting and some other meetings I've already had with clients, and I saw that number, I sort of remarked, wow, that's a big number. But I really wasn't sure how big it was, so I'm going to throw some stats out to you to hopefully put it into some context. So that 31.5% return in 2019 was the 17th highest return in the history of the S&P 500, going back to 1926. It's kind of interesting. It was the 7th highest return since 1980. That was kind of interesting to me too. But this one was the one that struck me. So you'll all recall in the late 90s, the market was absolutely roaring before the telecom technology and media bubble burst. Late 90s returns were sort of off the charts. There were only 2 years in the late 90s. It was 1995, where the S&P was higher than it was in 2019. So in 1995, the S&P returned 37.6. And in 1997, the S&P returned 33.4. So this 31.5% that we've all experienced really was quite extraordinary. And I think the reason for such a strong return in 2019 was, you'll recall what happened at the end of 2018 and how bad that was in the fourth quarter of 2018, with markets selling off and trade disputes between the United States and China, and the Federal Reserve raising interest rates, and the fourth quarter of 2018 was quite bad, and we got that all back and then some in 2019. So results are, when we talk about our own portfolio, they're going to reflect these very strong equity market returns that I've sort of alluded to here. If you on the table on the left hand side here, these are different equity market indexes, the top one being the S&P 500. About 3/4 of the way down, you'll come to something called the MSCI EAFE index. So this is an index of non-US developed equity markets. For the full year, those markets, think Europe, Japan, Australia, those kinds of markets, 22%. So good results, but about 10 percentage points or so below what we had here in the US. And then the second one from the bottom there, the MSCI Emerging Market Index, up about 19%. Again, strong in absolute numbers, but it was really the US equity market that was driving such impressive results on the equity side. If you go to the right-hand side of this page on the top, you'll see a bunch of equity sectors there. So the returns that we had in 2019, the rally in the equity markets was broad-based. Every single sector of the economy generated strong results. The worst was energy, up about 12%, and the very best was technology, up over 50%. So again, you're starting to hopefully paint this picture of how strong 2019 was and how broad-based it was. If you flip the slide, this is a quick snapshot of the fixed income side of things, so moving away from equities. The broad market, this BC US Aggregate, it stands for Barclays Capital US Aggregate Index. It is an index of investment grade bonds. It is the broadest representation of the fixed income market in the US. That index was up 8.7% for 2019. That's another good number. Obviously not as strong as stocks. We don't typically expect that. When stocks are up 30%, it's very unusual to see bonds generating as strong of results as they did in 2019. And the reason that bond returns were strong as well is because interest rates declined during 2019. So if you looked at the 10-year Treasury bond, we ended 2018 with a yield of about 2.69%. We ended 2019 at about 1.9%. So, and they're even lower today. They're about 1.6% today. So interest rates, despite what people like us have been saying and consensus that interest rates are heading higher, they continue to head lower. So it's been good for bond market returns. We're going to get into our outlook in a little bit, but this is just sort of a recap of what 2019 looked like. So if you flip the page to page 8, we'll take a quick look at the pages 8 and 9, the value of the pension trust at the end of December, and then how the portfolio is positioned in terms of broad asset allocation. So we ended 2019 with about $220 million, a little bit more than $220 million in assets. And broadly speaking, what we're targeting in terms of our asset allocation exposures is 70% allocation to global equities. We'll get a little bit more granular in a second. 22% to bonds, and 8% to alternatives. And we're defining alternatives, a little bit of hedge funds and a little bit of real estate. So roughly 70% equities, 30% other stuff. If you turn to page 9, this takes a little bit more granular look at that allocation and where we were at the end of the year relative to our targets that are specified in the investment policy statement. So we ended 2019 at 71.4% allocation to equities, and you can see that in the second column of numbers in the table on page 9. You'll see equities, that's a 71.4 relative to our target of 70%. So we're a little bit over allocated to equities, and that was a good place to be given equity markets were so strong. Right below that number, you'll see our allocation to both U.S. equities and then international equities. So roughly, what is that? A little bit more than 50% of our exposure is in U.S. equities, and the remainder in international equities. So we got a really well-balanced portfolio between U.S. and non-U.S. We certainly participated in those very strong returns that the U.S. was driving, and the strong returns that were generated in overseas markets as well. But when we talk about the managers, you'll see that we had some pretty darn good managers that did really, really well, even in those markets that didn't do as well as the U.S. equity market. So we'll talk about that in a minute. Within international equities, you don't really see it here. We have a bias, a slight bias towards emerging markets as opposed to places like Europe and Japan. And we talked a lot about that yesterday with the investment committee about the rationale for that and our comfort around that exposure. And again, when we talk about the individual managers, you'll see that not only did, so that overweight to emerging markets, that was the worst returning equity market around the globe, but we had a manager that not only beat that benchmark, but it beat the return of the U.S. equity market too. So we'll talk about that in a minute. So the fact that we had that little slight overweight to equities means that we were slightly underweight to fixed income and alternatives. Again, that bias towards the higher returning markets helped our return, and we'll show you that in a second. In fact, we'll show you that right now on page 10. So here's a quick look at performance. So we're showing the fourth quarter of 2019, we're showing the full year of 2019, and then we're showing this custom period, which is the point at which our relationship with the board changed to be one where we have discretion within certain limits to implement the strategy. In all three periods, our return, and these are net of fees, our return exceeded the benchmark. Benchmark, if you go all the way to the bottom of page 10, you'll see City of Portsmouth BM, that's the benchmark. And what this says is if we were at our target weights to the asset classes, so the 70% stocks and 22% bonds and a little bit in real estate and hedge funds, if we were exactly at those targets constantly and we earned nothing but index returns, this is the return that we would have earned. So for the full year, 21.7, pretty good result. Markets were strong, as we talked about. You go right below that, this is our actual return. So this is the fact that we were a little bit overweight equities, a little bit underweight bonds, and the impact of the manager selection and their ability to generate returns in excess of their benchmark. We actually earned 23.6%. So we outperformed the benchmark in 2019 by almost 200 basis points. Net. So, yeah, and these are net of fees. Very strong result. And the results exceed the benchmark for the fourth quarter and for this custom period as well. So the strategy that's in place that you all approved and that is being implemented is working, and I would argue is working very, very well. I'm actually going to flip ahead to page 21, where it starts to look at some of the individual manager performance. And we show fourth quarter results in the middle of the table. We show the full year and then that custom period, which is pretty close to the 1 year period. It's just we pick up a couple of extra months in 2018. So we use the strategy that we use to implement the asset allocation targets is we use a combination of both passive investment strategies. Passive investment strategies just seek to replicate the overall market's return. It's very low cost, very well diversified, but there's no expectation that we're going to generate a return significantly better or significantly worse than what the market provides. So we use a little bit of that. And then we use a fair amount of active management, where we expect those managers, after the fees we pay them, to be able to generate returns in excess of their benchmark. I'll tell you, we have 11 active managers in the program today, and in 2019, 8 of them outperformed their benchmark. So that's a really good batting average, and in a lot of cases, those managers significantly outperformed their benchmarks, and that's what we're going to talk about right now. So there's a lot of lines and numbers here, but we'll just kind of go line by line here. I'm going to skip over the first grouping of numbers there, but right below that you'll see BlackRock. BlackRock is one of our fixed income managers. And if you go to the 2019 column, their return was 8.35%. Benchmark's return was 8.72. So here's one manager that underperformed slightly. Relative to their benchmark, they underperformed by about 0.4% in 2019. BlackRock is, like a lot of us, has believed that interest rates are going to rise in the future. And as a result, they've structured their portfolio to be sort of a shorter maturity profile than what the overall benchmark looks like. And as interest rates have continued to come down, when interest rates come down, bond prices go up, and longer maturity bonds go up more than shorter maturity bonds. So that slight duration mismatch that BlackRock has built in the portfolio to capitalize on their view of higher rates hurt them a little bit in 2019 as rates continued to decline. 40 basis points, not a huge number, but they were one of the managers that underperformed. Right below that, the American Euro-Pacific Growth Fund. So this is one of our active international equity managers. They have some developed market exposure. About a quarter of their portfolio is in emerging markets. Their return for the year, 27.7%. The benchmark's return of 21.5. So here's one that outperformed. Here's one that outperformed by a significant margin. Over 600 basis points of excess return in 2019. Very strong stock selection, even though they had a big slug of emerging markets. They did well across all the markets in which they invest. The other manager below that is another one of our active international equity managers. Their return was 25.9%, again, versus the benchmark of 21.5. So over 4 percentage points of excess return that this manager was able to generate. This manager runs a very concentrated portfolio. They held about 25 stocks. And so all the return difference that's coming through relative to the benchmark is going to be a function of, they had good companies, they bought good stocks that went up more than the market. And 2019 was a strong year for them. Skip down a couple of lines. Here's our one of our emerging market manager, this Artisan Developing World Fund. Here's where the numbers get kind of really good. 41%, over 41% in 2019. Again, remember we talked about emerging markets were up about 19%. That's strong in absolute terms, but relative to the rest of the world, it was the worst performing equity market, sort of geographically. So not only did Artisan outperform the emerging market benchmark of 18 and change, did it by over 20 percentage points, but they also beat the S&P 500, ironically, which was the best returning capital market in the globe, around the globe. So really strong results, and this is a manager we've had for a while now, and they continue to do really well, and we're obviously delighted with the results there. Next below that is the Lord Abbett Short Duration Fund. So this is another fixed income manager for us. It has a little bit of a shorter maturity profile than even the BlackRock portfolio that we talked about earlier. We benchmarked them against a shorter maturity fixed income benchmark, and they were able to outperform that benchmark by over 1.3 percentage points. The one big challenge for us in 2019, and we talked about this at the last meeting too when we reviewed results, was the one right below that, Rice Hall James. So they are a small and mid-cap growth manager in the United States. They generated a 19% return, a little bit more than 19, but their benchmark was up over 32%, so they underperformed by 13 percentage points. And as we talked last time, a lot of the underperformance that's coming through from this manager is a function of the stuff that they don't own, given their process. So in the biotech space, there's a lot of companies in that world that don't really have revenues yet because they're in drug trial phases of certain drugs that they're hoping to develop. And a lot of times what happens with those companies is either they work or they don't. And so they're worth a lot of money or they're worth nothing. So there's this binary outcome. During 2019, there were a lot of those companies that really didn't have revenues that are not the kinds of companies this manager buys, but they were acquisition targets, and they were acquired by larger pharmaceutical companies, and those larger pharmaceutical companies paid huge premiums for those companies. So the fact that they didn't own those, but they're in the benchmark, and the reality is they were never going to own those because they're not the kinds of companies that they invest in, means the benchmark's return was really strong, but theirs didn't quite keep up. Now, that's a big chunk of the underperformance, but I'm not going to sit here and tell you that that's all of it. They picked some bad stocks. So we've been in constant dialogue and communication with them just to decide what, if anything, we think we should do with this portfolio. And I'll just tell you that we're inclined to stay the course for a couple of reasons. Number one is they haven't done anything different than they've done historically, and that's an important consideration for us. When you look back historically at this manager's performance, it really is the period that which we owned them that is the worst period in the manager's life cycle. It doesn't make you feel good, but it is sort of an unusual period of underperformance for this manager given its history. So the fact that they haven't changed their stripes, the fact that they continue to buy the companies that they've always bought and focus their analysis on the things that they've always done, to us suggests that we don't necessarily want to bail here at the low point in the manager's life cycle. So again, we're inclined to stick with them. If we learn anything new, we'll make a move. But we still, believe it or not, like the manager. We think they do a good job. It's just this period of time of a couple of years that we have held them that's been the worst in the manager's history. And the reality is 19% isn't too shabby, but it is when you compare it to something that's up 36. Any questions on that? Just flip the page one last time. Here's some other of the active managers that we have. Here's the Poland Large Cap Growth Fund, almost 23%. Their benchmark was up a little less than 21, so 2 percentage points of excess return. Below that, our Large Cap Value Manager outperformed by almost 6 percentage points. Below that, Small Cap Value, another 6 percentage points. So you get the idea. We've our allocations worked for us. We were a little bit overweight equities at a time when equity markets outperformed. But what was really driving those results when we talked about total fund results was the very strong returns of the active managers we have in the portfolio. So with that, I'm going to stop and see if there's any questions. Otherwise, we can sort of get into how we think the world's going to unfold in 2020.
I just have one question about the alternatives allocation. Can you just briefly describe the role of that part of the portfolio and why you want us to stay there?
Yep. So our objective in allocating to alternatives and then structuring the portfolio the way we did was to further diversify the other stuff we have. We've got a lot of equity market exposure. We got 70% in equities, 22% in bonds. So we wanted to have something else that was going to provide good returns over the long run, but that were going to perform maybe differently when the big chunk of our portfolio, the 70%, maybe isn't doing as well. And that's the whole role of alternatives. When we define alternatives, it's we've got a mix of real estate, some equity-oriented strategies, and some bond-oriented strategies. But with a lot of the hedge funds, and certainly some of the hedge funds that we have in place here, they can make money irrespective of what's going on in the other capital markets, because they can buy things that they hope go up in value, and then they can sell short things that they think are going to go down in value. So it provides some diversification benefit to the equities we have, and over the long run, we expect them to generate some pretty decent returns too.
Patty, this is Laura.
Yes.
This is a really great picture that we have. Is there anything that will be done to share this with council? I mean, there was some concern among some of the members that our returns weren't all of that favorable, and this certainly paints a much different picture than that.
If this body would like a brief report to City Council, I can prepare it.
What are your thoughts for it?
I think the last report, in my opinion, the last report we did in front of council pretty much mirrors what we're talking about today. Do you agree or not, Landa?
So we've had I guess, only a half a year of results since we last presented to the board and even, or to the council, and even in that presentation, our returns were favorable, even though I guess the reaction of some of council wasn't what we would expect based on the results. So I don't know. When you say deliver a report, like formal report at an open council meeting, or something internal,
I'm just,
an email or something?
my thought would be a memo.
A memo.
And Mr. Challenger, is there a requirement for this board to report to council more
Yearly.
just annually at
Yes,
this point, not
annually.
twice a year? Okay.
Annually, and I think we did that last, was it October?
October, November, something like November, I think it
November
was. Yeah.
for the period.
So I would imagine it would be roughly the same time period, October, November 2020.
That's what I'm thinking.
I would be okay if it's just a memo, but I don't think some presentation at a council meeting is warranted. But
Yeah, I was
an update like a memo.
I wasn't suggesting in person.
Because otherwise, since we have, I know we have fiscal year versus calendar year, but we finished calendar year, and I guess it wouldn't be a bad idea. It's sort of halfway through the fiscal year for an update, if it's, or unless we're worried that that's just going to create questions and then end up becoming some sort of full meeting council.
If the strategy is it's a simple 1 or 2 page memo that outlines the performance of our investors against the benchmarks for the end of the calendar year in response to several questions from council, it might be appropriate. You couch it very nicely like that. There's some concern expressed by whoever it was. We thought that the end of calendar year performance might be a good idea to show you how your trust that you've entrusted us with is doing against other investment benchmarks. I think there's not a whole lot of downside there.
Well, if we do the memo, then I would feel that we need to do the whole picture, like get John Hancock to agree the $6.5 million increase the funded ratio, that we are still underfunded, but we are on a good path to, we have adequate resources to make our pensioners' obligations, to just kind of put a little framework on it, because I think that would be the next question. We're doing good, doing very well. Of course, we have a very booming equity market, as Brian said, so next year or 21 could be the year that it goes the other direction.
Yeah, I was just saying, we are reporting on that which we have control of, which is the investments. We can't control how quickly people exit the system so that we no longer have to pay benefits. So.
Well, yeah, okay.
Just my 2 cents. I think we had a very productive update to council when we went last time. Personally, I don't really see the real value of updating now because it really hasn't that much changed since before. We really kind of continuing on the same trajectory that we were in before. And quiet is kept. Before we know it, we'll be right back in October of 2020 as fast as time goes.
That's the truth.
And to me, we're talking about creating more work and maybe diverting our attention from other areas when I don't really see the impetus for us to even go on that project, personally.
Because the message is the same.
Yes.
The message is exactly the same.
There's been no changes in the
Right.
portfolio in terms of the strategy, and it has only been a few months. It may have been 6 months in terms of accounting, but in terms of when we touch bases with them, it's only been a few months.
And if they had wanted updated information, they would have said, in my opinion, they would have said, can you keep us updated on how this is going?
This would be a great
Okay.
meeting for Councilman Glover to be here.
For his advice, yeah.
Thanks for the discussion. Thank you.
Very good.
Okay.
So okay with not sending a memo?
Yeah, I'm okay with not doing it, yeah.
Okay.
I'm okay with not doing it.
Very good.
Just a note on the alternatives, good question about the role they play in the portfolio. So they're listed on slide 12 of your meeting book.
Yep.
And we're careful about including these in the portfolio allocation for obvious reasons, and I'll just point out a couple things. The use of alternatives is generally new to this particular portfolio, and if you look at the lockup to the far right, 3 of the 4 have no lockups. 1 of them has a 1-year lockup, and what we do want to draw to your attention to, we just made a commitment to a real estate fund, Oak Street Real Estate 5, which is a single-tenant, triple net lease investment, where the capitalization rate is about 7%, and they have for years paid out 8%. So we think there's an opportunity for outsized returns there, plus we get the benefit of the cash flow, and we know cash flow is important to this portfolio. But it is a long-term lockup. It is very illiquid, so we want to make the board aware of that. We certainly have discussed it with the investment committee. And so we may have more going forward, but we're highly selective in terms of introducing those to the portfolio.
Remind me, Jim, how much we have in that Oak Street? How much did we invest?
I think we've committed $4 million, 4 or 4.5, I don't.
None of which has been invested yet.
Correct.
It'll be called over time.
All right. I think that's all we have on the agenda. So if no one else, Mr. Challenger?
Just a quick update. That next session, I guess that would be March meeting. I wanted to give a quick summary of the NAPA conference that I'm going to next week, and I wanted to kind of combine it as a update on the conference as well as corporate governance update as well. And I was thinking maybe a 15-20 minute presentation, if that's we have room on our agenda, would be a good update for us.
Yeah.
I'm good.
And that's, just remind me again, that's like National Association of Pension Attorneys?
Yes.
Okay. Yep.
Could I ask, Brian, could you share your outlook for the rest of the year with us?
So we have some slides. If you all have time, I'll walk you through.
He did say that they were going to do that.
There are two handouts. There's this one, it's Equity Market Outlook, which I'll walk through. And then there was a second handout that was circulated, which I'll address, which is the coronavirus impact on the world economy. So does everybody have this deck in front of them?
Yes.
So I'll go through this quickly. I know everybody's pressed for time, but it's an interesting time of year to go through these slides. It talks a little bit about our forecast. So what Brian and I decided to do is take two different perspectives. One is the traditional Morgan Stanley Global Investment Committee. The first set of slides here is from a member of our Global Investment Committee, Andrew Slimman, and he's got a very interesting approach to the markets and the market outlooks. He is focused only on factor analysis. So he has no opinions, personal opinions or biases built into his forecast. And he's the only Global Investment Committee member that actually manages money for a living as well. So he has a very interesting perspective. I thought I'd share that with you. Then I'll cover some of our standard Global Investment Committee slides. So on the first slide, this is for the U.S. equity market. He was very bullish last year. He always starts with his conclusions and likes to keep everything really straightforward and simple. So green light for 2020, U.S. equities. His primary concern would be too much economic growth, and I'll elaborate on that in just a few minutes. So he believes that secular bull markets end from too much excess. They typically don't just die of old age. So we need a booming economic growth, which typically leads to a bubble. Brian talked about that tech and telecom bubble during his opening comments. And he doesn't think that that's what we're seeing in the U.S. economy. And then when these bubbles burst, that typically is what leads to a recession. We look back at the 16 prior bear markets, and 13 of those were in front of a recession. And most of those were from a bubble bursting. So his conclusion is, the bottom of slide 2, is we need to see a boom before a bust.
So the boom meaning an economic boom, GDP growth?
Perfect question into the next slide.
I was like, 31% feels like a boom to me.
Not from a GDP standpoint. So if you look at the next slide, slide 3, it's this low growth that has kept him very optimistic for some time. I think the average GDP growth here, going back to Q1 15 has been going back to mid-2009, coming out of the Great Recession, has been about 2.3%. So we've had 127 months of pretty slow economic growth. And he likes this. This keeps him bullish, because this is what prevents the strong economic growth, is what creates the bubbles, which creates the recession. So low growth is good because the bar is low and the risk for a boom is low. And that's effectively what we're seeing here on slide 3. So the forecast for GDP growth for the first quarter of 20 and out through the balance of 2020 is still relatively tame, relatively muted, and that really keeps him quite bullish. Stanley, he has a quote a few slides later at Stanley Druckenmiller, who is famous for managing George Soros' quantum fund, said, low growth with a supportive Fed, stay invested. It's really, really simple, really straightforward. And we have a very supportive Fed. We have low growth, stay invested. So we'll be keeping our eye on economic growth. And I think if he does get concerned, it'll be because the economic growth has a very strong acceleration, which there is a chance in the back half of this year for reasons I'll mention in a minute. On slide 4, we talk a little bit about again, he's data-driven. He has no personal opinions either way, embedded into his analysis. Here on slide 4, we're looking at the presidential cycle. His view is economic data will improve this year. So if we look, no recession, this is on the left, in 2 years prior to the election. You see multiple occurrences here. Did the incumbent get reelected? Answer is yes, every single time. And then to the right, where we had a recession 2 years before the election, did the incumbent get reelected? No, all but once, but that was quite some time ago, in the 20s. So when you think about what has happened from an economic growth standpoint, what the current administration wants is a very strong 2020, and the most important quarter is the third quarter. So he would argue it's not an accident that trade relationships with China were resolved in January of this year. That'll help stimulate growth. NAFTA free trade agreement was resolved in January this year. That should help growth. It takes 3 to 5 quarters of Fed movements up or down before it starts to really filter through to the economy. So we had rate cuts, so that should help. We have a very strong stock market in the U.S., so there's a wealth effect multiplier, so that should help as well. So it seems like a lot of the data is set up for stronger growth in the second half of the year, which is consistent with this presidential. Next slide addresses the topic that was front and center for investors for some time and seems to have faded, and that is the inversion of the yield curve. So I'm on slide 5. Sorry. Sorry about that. The green circle represents the period where the inversion took place, and when we speak of an inversion, we're talking about the 2-year U.S. Treasury yield yielding more than the 10-year. And it doesn't happen very often. So it happened August 22nd, 2019, as you can see from the bottom of the slide. And then we show the date the stock market peaks from prior inversions, and on average it's been a little over 700 days before the stock market's peaked. We're about 125 days into the last inversion. But most importantly, you can see the S&P 500 gain from the peak of that inversion going back in time. So post-inversion, there's been quite a bit of room left in growth run in the equity markets. And his view is it's the most concerning thing about the inversion is when people tend to forget about the impact of the inversion. And about 2 years out, 18 to 24 months, it tends to lead to a recession. So again, for him, it makes 2020 reasonably solid, but he will start to get concerned from the inversion of the curve sometime in 2021. On slide 8, 8 and 9, this relates to money flows on the part of retail investors. So we're not talking about institutional investors. He would view the fact that where he sits at Morgan Stanley is the mutual fund business is a great lens into human behavior and how retail investors invest or don't invest. Brian mentioned that at the end of 2018 we saw a pretty significant sell-off. So the peak to trough sell-off was almost 20% in a very short time period. And every time that happens, what we see retail equity fund redemptions. So the retail investor gets spooked, starts to sell equities. And I'll go through some numbers with you in just a minute. So institutional money flows like this very constant, long-term focused, not spooked by ups and downs in the market. So we did see these redemptions, but he stayed very bullish during all those redemptions. A couple things he mentioned on our conference call together. He said part of the reason he stayed defensive was that the number one most popular investment product for retail investors in our franchise for 2019 was it's a short-term investment fund. So effectively, it's a money market fund with a slightly longer maturity. That's where all the money rotated. So nervous investors were heading for the hills, buying money market funds. And then he looked at the valuation of safe sectors of the economy like utilities, and they were trading at almost 40-year highs. So his view was during that time period, most of the investors were already in the hills. There was no place else to go. And so he starts to look at the money flows for retail investors. And that's what we're looking at here at slide 8 and 9. If you look at period of we have different periods starting 2011, 15, and then 2018, but the message is the same. If you see these big drawdowns, these sell-offs, in 2011 it was 19%, 2015 it was 14%, and then 2018, as I mentioned, was 19%. The equity ETF mutual fund flows become negative, stock market does reasonably well, and then the second year after, usually it takes about a little over 12 months for the wounds to heal, the sharp sell-off, and you start to see the retail investor come back into the market. So we saw, using 2011 just as an example, 60 billion of negative flows. Then we saw almost a little over 28 billion. Then in 2013, after that 2011 sharp sell-off was behind us, we saw massive inflows. Same thing we saw with the sell-off in 2015, money flows coming out, and in 2017, massive inflows. So his point on slide 9 was we had equity ETF money flows coming out because of the sell-off in 2018, which happened right at the end of the year. Big money outflows last year, and then we saw very strong equity performance, up 31%. So he just doesn't think it's going to be any different for 2020. He expects to see the retail investor rotate back into equities. He's not predicting 31%, but he thinks the markets will be fine. Last slide from Andrew is this volatility during a U.S. presidential election. That it's pretty easy for strategists just to say expect more volatility. They pretty much do that every year. His view is that's not going to be the case this year. For all the reasons I mentioned about earnings and growth starting to get some traction by mid-year and perhaps the second half of the year, that should keep volatility pretty low, combined with the fact that we have a Federal Reserve that has effectively stepped to the sidelines. It would take a lot at this point for the Fed to cut rates or a lot for the Fed to raise rates during an election year. I'll just go through a couple slides from our Global Investment Committee. The next one is probably one of my favorites on slide 15. And this really summarizes what happened last year around the world. And 2019 was just the opposite of 2018. What we're looking at here is a breakdown of contribution of total return around the world. We'll start with the S&P 500, and that gold bar represents an expansion in PE. So investors are willing to pay more per dollar of earnings is what that means. The actual earnings growth is in the purple. So earnings growth for most of the major regions around the world were negative. I know sometimes that's pretty hard to believe that earnings growth is negative, and yet we have all of these strong numbers that Brian reviewed with you. In the U.S., it'll probably end up being up 3-ish%. So earnings growth is up 3% in the U.S., and you get a 31% rise. Almost all of that came from multiple expansion, higher P's. And the earnings growth around the world was even worse. It was negative, and yet we had very strong markets. And of course, the reason for that is investors are discounting future growth, and they expect better growth in 2020 and 2021. Let's skip to slide 17 for just a minute. We had questions about, well, is it just a bull market in the U.S. and the S&P? This is the MSCI All Country World Index, so it's one of the broadest indexes available. About 47 countries are represented here. I think there's over 2,700 stocks in this index, and you can see it's broken out around the world. So it's not just a U.S. bull market; it really is a bull market. Around the world. There's been some consolidation taking place and a bit of a trading range around the world, but now we've finally broken out in all the major indices. On slide 18, we've looked at this before. Again, we to be perfectly clear, we think we are still in a secular bull market for equities. The smaller circles represent just a correction in this secular bull market. So we've had corrections in 2011, 15, 16, and 18. But we don't think that we're in a secular bear market, which is represented by those big circles. The last two slides I'll cover are on slide 19 and 20. Slide 19 is our view of earnings growth versus the consensus. So this is the Morgan Stanley forecast versus consensus for different regions of the world. Our S&P number now is probably up somewhere between 3% and 5%, but still it's about half of what the consensus is for the S&P. So from a portfolio construction standpoint, this causes us to want to tilt the portfolio outside the United States. And as you know from Brian's review, the tilt for Portsmouth is in the emerging markets, so slightly overweight emerging markets. Hard to know for sure what the tilt will be, if any, for the course of the year, given the views on the U.S. market, but future allocations with the data that we have today would likely suggest that those tilts would be more outside the United States going forward. Then on slide 20, we do certainly get some questions about value versus growth investing. The Portsmouth portfolio has a tilt towards value. We still think that this trend will continue over time, but I think it's really important to recognize that the value investing the style makes most of its money coming out of a recession. That's when you get really outsized returns. It just so happens that growth has done so well for so long, it was hard to ignore and not put a tilt in the portfolio, but the big periods of outperformance are coming out of recession. So those are the slides. I don't know if anybody has any questions. I'm happy to take them. I'd like to welcome Mr. Munson to the investment committee. If there are no questions, I'll just close with this: is that we work with a very strong investment committee who has overseen quite a transformation of the portfolio since our engagement, and absent that commitment to the transformation, the portfolio probably isn't as well positioned as it is today. We've been fortunate to work with a strong group and certainly look forward to Mr. Munson's contributions.
Thank you very much. Appreciate you presenting and coming here today.
Our pleasure.
Ms. Phillips, you have something?
I just wanted to make an announcement. The budget officer for the city of Portsmouth Trey Burke is asking if he had time to sit in, just so he could get a sense of how this group works. And, who knows, after he may be running this someday. But he had an interest, and I think it's a great place to hear some good information.
Thank you. I think that's all, and we can adjourn.